Chapter 4, Managing Money. This is Section 4C, Savings Plans and Investments. This is our second video, and so we'll look at investments in this video. Savings plan is covered in the previous video. There are a couple of different types of investments that you can make. We're going to specifically look at mutual funds, bonds, and stocks. The total return on an investment is the amount that you have gained divided by the principal amount that you initially invested. Then you change that to a percent. The annual return is the amount of money that was in the account after you've closed the account, so the interest and the principal divided by the principal. And then you're going to raise it to the exponent of 1 over the number of years that you've left it in the account. Then you're going to subtract 1, and when you change that to a percent, you'll get your annual APY, right? The annual percentage yield. That's going to look a little bit different than the APR, right? Because that is looking at what you would have needed to get if it wasn't compounded. Here's an example. You invest $3,000 in a Clearwater mutual fund, and we'll talk more about what a mutual fund is in a moment. Over 4 years, your investment grows to a value of $8,400. What are your total and your annual returns over the 4-year period? All right, so your total yield, all right, how much you've earned overall, is the amount that was in the account when you closed it, so $8,400. Subtract out your initial principal, and then divide by the initial principal. Hopefully this is a percent of increase, right? Not a percent of decrease. It's the same formula. Then change it to a percent, and you would have had a percent of increase, a total return of 180%. So that worked out very well. The APY that you would have gotten if this was sitting in like a savings account somewhere, you take the amount that you've earned, total, principal with the interest, divide that by your initial principal amount, and then you're going to raise it to 1 over 1/4. The 1 is a part of the formula. The 4 is because we left it in there 4 years. Now you notice that in the next line it says 2.8. Well, that is what 8,400 divided by the 3,000 is. But then it says the fourth root of 2.8. You do not need to change this exponent, which we call a rational exponent because it's a fraction, over to the root form. These two things say the exact same thing. I can simply, in my calculator, raise it to the 1/4, and quite frankly, that's easier in the calculator because there's a lot of button pressing that you have to do to get it to be the 4th root and not a square root. Take that, and you get 1.29 and some change, and now I need to subtract out the 1, and so I would have had a 29.4% annual return. So I'm making about 29% each year. That's fantastic. Let's look at the specific types of investments. There's stocks, and you've seen these like on the news, where you buy a share in a company for a certain value. And the only way, for most stocks anyway, that you get money out is that you sell the stock. There are some stocks that get dividends that you can kind of get like a kickback every year, but you have to be a preferred stock for that. If you just have a regular old type of common stock, you buy it, you hope it goes up, you sell it, you make money. The stock prices change over time. That is actually an understatement. I mean, it changes literally minute to minute, second to second. So if you are watching the ticker, it's going to change all day long. Stocks are long-term investments. There are people who are day traders that will buy at 8 a.m. and sell it at 8 p.m. But in all likelihood, if you want to make money long-term, you have to buy and hold for a long time. That's how you make money in stocks. They're the riskiest of all the stocks. That also means you're probably going to get the highest rate of return. A bond is similar in that you put money in and then it earns interest and then you cash it out at the end. You're going to get a simple interest, and sometimes bonds are sold at a discount or a premium. So if it's sold at a discount, let's say it's that $1,000 bond, you'll only have to put up $800, but you'll earn interest on $1,000. If it's sold at a premium, you'll have to put up like $1,200, but you'll only get interest on the $1,000. Bonds could be $1,000. They could be $10,000. They could be $100,000. But bonds are very, very safe because they're like a fancy savings account that is locked in over a period of time. Of course, there's cash that you can buy, that you would put in like a CD, which is also kind of like a fancy savings account where it's a much shorter term. So you put your money in for 3 months, 6 months, 9 months, something like that. And at the end, you earn a little bit of simple interest. You got your regular savings accounts. There's also money market accounts that are like souped up checking accounts that you're allowed to write like 3 to 5 checks every month out of that account, and then you still earn interest. There are treasury bills, which are kind of like big certificates of deposits. I think they start at $10,000, but that might have changed over the years. But you earn a little bit more interest on the U.S. Treasury bills than the CDs. CDs are a great way to save money without locking it up for a long, long period of time and get a little bit more interest, because you can have 3 months and then every 3 months it rolls over. So you'll still have interest earning interest. You need to think about liquidity, which is kind of what I was just talking about, the rollover, the risk, and the return. Liquidity is how difficult it is for me to get my money back. So a savings account, that's easy. You go down to the bank, you hit the ATM, you're good to go. A CD, you're going to have to wait 3 months or 6 months or whatever the term is to get your money back, or else you're going to wind up having to pay a fine, which basically is going to eat up all the interest that you would have earned. So it's good to have them set up so that every like 3 or 4 months or so you have something coming up. And you can even set it up that every month you have something coming up that you can pull out of. So in case something happens, you have access to a kind of a chunk of money. Now, the longer you're willing to lock it up, that lowers the risk and that kind of raises the risk for you, because you're not going to be able to access your money. It kind of depends on where it's locked up. Is it in a stock? Well, that's very risky, but you can get it any time. But you're going to make a lot more than if you left it in like a 10-year bond. I wouldn't say that's risky, but the longer you leave it in there and you risk access, then you're going to get more money on that. When you are buying a bond or you're putting money in a bank, not a stock, so a CD, a savings account, something like that, you're basically letting the bank borrow your money. That's why you're paying interest. So if you were to get a mortgage, you're borrowing money from the bank, you give them interest. When you're putting money in the bank in your savings account, it's like they're borrowing your money. That's why they give you interest. Just not as much as if you were taking out a mortgage. Stock market trends, they change. This is in years, but like I said, it will change minute to minute. There's the Dow Jones and the S&P. The Dow Jones is, I think, 50, what they call it's 30 blue chips. I thought it was 50, where it's big companies. So you're talking Apple, Microsoft, something like that. And then they average out those big players, and then you get an average. Hence the term, right, of the title of Dow Jones Industrial Average. The S&P 500 is much bigger. It looks at 500 different high action stocks and takes the average of that. They tend to be kind of lockstep, but they're not going to be the same. So when you sell a stock, you make something called a capital gain, and that is taxed at a different rate than like your paycheck. Capital gains, you may have heard about it on the news, tend to be very high, 30%, I think, or 36%. It depends on how long you held the stock, on how much tax you pay, because there's long-term and short-term capital gains. Some people do earn dividends, like I said earlier. That would get taxed yearly as a part of your income, and that you would claim on your taxes at the end of the year. Reading the stock stuff is a little crazy, so you have to know the secret code. Let me see if I can make this a little bit bigger so you can see it. Right, so it doesn't say the whole thing. It usually has like a 3 or a 4 alpha, sometimes the alphanumeric code. It will tell you how much has changed since the last day, the percent, so the relative change and the absolute change, what the last close was, what it opened at, what its high is usually. Okay, that's for the day, and the low for the day. This is the 52 1 year and high and low. You got a market cap, so that's how much money that they have out in stocks. PE is price to earnings ratio, so the earnings of the company and profit over the number of shares. The dividend that they paid, you can see that they're usually not that fantastic, but if you have a lot, it adds up. The yield and how many shares they have out there. You're really interested in this PE ratio. That is what should tell you what a stock is worth, right? The higher the PE ratio, the more that you're earning on that individual stock. But since the tech bubble in the early 2000s, it's kind of been a little out of whack. So if I want to look at my Microsoft, what was the symbol for Microsoft? I'm going to go back and forth a little bit here since we have a lot of information on the previous slide. The symbol is MSFT. All right. The quote right now on this slide is 1976. Oops, there we are. And it went down 13 cents. So at the beginning of the day, it was $19.89. So not crazy. The volume of the shares out show that there are a little over 33 million shares out, each at 1976. So there's over $650 million out worth of shares. That's the shares traded today. Wow. The value for the outstanding shares shows that there's a total of almost 9,000 shares. That's in millions. I missed that on the first slide. So you have a little over this 1,000 million billion. So your shares divided by the how many quoted shares. You only have the shares traded today, under a very small percent of the shares that are outstanding were traded today. So this is how many shares there are. This is how many that got traded. At 100 shares, at $19.76, that would be worth $19.76, right? Almost $2,000. If the dividend yield is 2.61%, you would make about $51-ish in dividend payments for the year. A lot of people don't make dividends. Much like simple interest and compound interest, the way you live off the dividends is that you had a lot of money already invested. Bonds, there's that face value, or that you have to pay the issuer for the bond. The coupon rate, that's what you're going to get paid interest on. And the maturity date, that's when you're going to be able to get all of your money back. And the yield is the annual interest payment. So just the annual interest payment for that 1 year divided by the current price of the bond. So if I'm going to make this a little bit smaller. I have a bond that is valued at $1,000. It's quoted at 105.97. So this guy's at a premium. You're going to earn 3.7%, but you're going to earn that interest on not the $1,000, but $1,059.70, right? So if it's quoted at points, this means you're getting paid extra interest. So you got to put up $1,000, but you're going to earn interest on that. You're going to earn more. You're going to earn interest on this. So the annual interest is the 3.7% on that premium. And then you're going to divide that by the current price, right? So $39.21, that's what you're going to get every year. And the current price was $1,000. Oh, I guess we don't have another slide. So you'll be able to get the yield off of that. So if you divide that by 1,000 and you change it back to a percent, the current yield will be 3.9%. So that's great. It says 3.7, but you're earning it on more than the $1,000. Mutual funds are kind of a hodgepodge of different types of investments. So it could be stocks, it could be bonds, it could even be Bitcoin now. They have crypto in there. There's a whole bunch of things. And you do stuff like this to kind of diversify what's your risk. There's a bunch. Vanguard 500 is kind of a big one. And it looks very similar that you have the symbol, tells you what the year-to-date total return is, about 2%. These tend to do fairly well because they balance out the risk. The annual, all right, it hasn't done so well in the past 3 years, but in the past year it's been doing okay. And this is the net asset for each share price. So based on the 500 Vanguard 500 mutual fund quote on the previous slide, how many shares will you be able to buy if you want to invest $3,000? Well, there's $3,000 that you have. Each one, it says, was $83.83. So I can buy 3.8 shares. And you can sometimes do stuff like that. You don't have to buy a whole share, which is a little odd. Let's look at some examples that you're going to see in your homework. Compute the total and annual returns on the following investments. 6 years after purchasing shares for a mutual fund at $7,300, so that's our starting value. The shares are sold for $11,400, so this is where we're going to end up. And we want to find the total and annual return, so we're going to have to back up in our PowerPoint to our formulas. So the total return is how much you made when you cashed out, and then subtract the value that you initially put in. And so this is going to be $11,400. Let's subtract out the $7,300. And then we're going to divide by 7,300. Let's get our calculator. So I'll put it over on this side. 11,400 minus the 7,300. Divide by the 7,300. And I got 56.1% when I round. So move it over first, move your decimal place first, and then round. So that is going to be our total. But if we want to talk about annually, I'll have to put it over here. We have a little bit of a different formula. It is the amount that you cashed out over the amount that you originally started with. So we'll have to say 11,400 over the 7,300. And this is 1 over y. So this is going to be 1 over 6, and then we're going to have to subtract out the 1. So now I need to move my calculator to the other side so that I have space. 11,400 divided by 7,300 is that. I need to raise this whole thing, so I'm just going to hit that caret key, and it will take this last answer and raise it to the exponent. Now I have an old calculator, so I'm going to need to put this fraction in parentheses. If you don't put it in parentheses on an old calculator, it's not going to come out right. If you have a newer calculator where you can see that the 1/6 is small and floating, then you don't have to worry about the parentheses. Hit enter. I'll subtract out the 1. So each year after I change this to a percent, that would be 7.7. when I round. So about 7.7 each year. And that's all you need to do for those. So that's how you find total and annual returns on an investment. Bonds. Calculate the current yield on the described bond. So it has a $2,000 face value. The coupon rate is 2.8%. Sometimes what they'll do is this would actually be the 100 minus the 2.8%. because my market value is 18.75. So this technically is a discount. Now you're still going to earn 2.8% on the full 2,000, even though the market value is only this. So why would you do that? That is when it's a little bit more riskier of a bond rating. There's bond ratings, I think, all the way from D all the way up to AAA, where AAA is the best. The really bad ones are called junk bonds. You get a higher percentage rate. You'll make more money, but it could be that whoever is issuing that bond defaults, and then you see no money. So let's figure out what 2.8% is of the 2,000, and I'll have to, oh, actually, I thought I was going to have to move my calculator again, but we're good. And so we're going to earn $56,000, that would be nice, $56 every single year. Now, the yield for bonds, if we can get to it, maybe it was back a little bit further. Let's see if we can find it. Maybe it's not in here at all. Oh, I think there it is. There it is. It's the annual interest over the current price. So now the current price is not the face value. The current price is going to be what you're paying for it. So my current price here is the $56,000 over the $1,875. Divided by 1875. Let's change this to a percent. So this is going to actually round. If I went 2 decimal places, that would be 2.99. Since this 8 would kick this 9 up to a 10, we're going to call that 3%. So that would be your current yield. That's all you need to do for that. Last one. I'll move it up. XYZ stock. $109.43 per share with a PE ratio of 12.81. How much were the earnings per share? So for A, I'm going to take that 109.43 and divide by this price divided by earnings, because that's what this is, right? So that's the ratio that I'll need to divide by. 109.43 divided by 12.81 gives me 8.54, $8.54. Does the stock seem overpriced, underpriced, or about right given that the historical PE ratio is 12 to 14? Well, given that this is only 8.54 and historically it's between 12 and 14, this is way underpriced. And these are the kind of problems that you're going to see in the second part of your homework for 4C about investments.